Hello, my name is Victor, and I have been investing in the stock market now for 8 years, and I personally love earnings season. In today's video, I want to talk about 3 of my personal stocks that I own because I just received their earnings reports. I analyzed everything in them, and I want to give you my opinion on what I think of the performances so far. And be sure to stick around until the end of the video because I'm going to talk about 3 stocks that I bought this past week. Let's not waste any time. Let's get right into it. The first stock that I want to talk about is Starbucks, and I have been looking forward to these earnings for months now. So let's not waste any time, let's get right into it because I'm going to analyze the income statement for all 3 of these stocks. So starting off right at the top here, revenue was up 6% for Starbucks. I was personally incredibly surprised to see the revenue up this high, considering how poorly Starbucks has been performing over the last 2 to 3 quarters now. But it is not all sunshine and rainbows for Starbucks because as we go down the line here, you can see that operating income was down 21% quarter over quarter, and net income staggeringly was down 62% compared to this time last year. Now, given that net income was down by so much, you would think that Starbucks would have cratered after these numbers were reported, and yet Starbucks soared to up to $102 a share after these earnings. Now, granted, because of the market crash later in the week, Starbucks did end up at about $92 a share, but what exactly was so great about these earnings initially that Starbucks was up by so much? Well, when we continue the analysis here, you will find this section here where it says that same-store sales were up by 4% compared to this time last year. And that is incredible and absolutely great news for Brian Nichols, the CEO of Starbucks, because it shows that his Operation Back to Starbucks initiative is on the right track. And it would seem to me that Wall Street was more focused on same-store sales compared to the net income because I feel like for the most part everybody knew that Starbucks' numbers were not going to be great. And I did talk about Starbucks a couple of weeks ago, and I did mention that Starbucks had some very exciting news with a collaboration with Mr. Beast. I also saw that they had a lot of hype, and I saw throughout social media that the barista cups that they were selling were flying off the shelves, people waiting in lines for hours to get their hands on those barista cups. And on top of that, the holiday menu is always something that everybody looks forward to, myself included. And for me, I think that there's a lot of little things that are going Starbucks' way now, whereas let's say this time last year, Starbucks could not catch a break. Everything they did was wrong. Everybody was hating on the stock, and things seemed like they just could not improve. Whereas now we have at least these 3 things that are going in Starbucks' direction now, and maybe this points to a rebound in Starbucks' stock here throughout the rest of the year. I did a brief PE analysis for Starbucks because I wanted to see more or less where they stand here at the end of January in 2026. When I did this analysis, very brief analysis, but I find that their fair PE value is still about 37, in my opinion. Their trailing PE over the last 12 months is 78, which is staggeringly high. But considering how poor the net income has been for Starbucks over the last 3 quarters or so, it's not a surprise to me. When I had a look at their forward PE ratio, and that is through this year in 2026, I get a 40 for the forward PE. And I know what you might be thinking, Victor, so what? What does this mean exactly? Well, the forward PE is much lower than the trailing PE, which means that there are high expectations for Starbucks throughout 2026. Now, with same-store sales up 4%, it is a good start, but I'm going to have to keep an eye on Starbucks because not only do I want to keep seeing those I cannot say that. Not only do I have to keep an eye on the same-store sales improving quarter over quarter, but I would say in the second half of 2026 is when I would want to start seeing the operating income and the net income improving and moving up and to the right for Starbucks as well. Now, I do not expect to see improvements in the very next quarter, but over the second half of the year, I definitely want to see that net income improving because this trailing PE right now is horrific. But that is it for Starbucks. Now we are going to move on to the second stock here in my portfolio that I got earnings on, and that is going to be Meta. And I do want to point out that for Meta, I looked at their 10K. So I'm not looking at a quarterly basis, I'm looking at an annual basis for this analysis. Keep that in mind. When I had a look at Meta, as I would expect, revenue was up 22% again through 2025, just like it was back in 2024. I love to see that strong double-digit growth for Meta. Operating income over this past year in 2025 was up 20%. Now, the only thing that I did not like about this income statement for Meta is that their net income was actually down for the year compared to this time last year, but just barely. They were down about 3% when it came to the bottom line. And it looks like for the most part, it was because of a provision for taxes. So nothing entirely concerning, I would say, in my opinion. But I would have loved for this entire form here to be marked in green. And it was just that bottom left corner that let me down. But overall, I would say I am incredibly impressed with this performance from Meta. And even more impressive for Meta is that their user base is still growing here through 2025. I took this part of their 10K and it is DAP, which stands for Daily Active People. So essentially, it's anybody and everybody who is logging into Facebook, Instagram, or WhatsApp at least once a day. And I cannot believe that they are still growing this number up 7% compared to this time last year. That is 3.58 billion users on at least one of these three services that Meta has here for everybody. And that is about half of the world using Meta. That is astonishing. And just the fact that they are such a massive company and still able to grow this much, I mean, it's amazing. It's absolutely amazing. And I mean, you can see here, I highlighted it in green. Worldwide daily active people increased 7% to 3.58 billion on average during December 2025 from 3.35 billion during December of 2024. But moving on now to the PE analysis for Meta, I have their fair PE ratio at 27. Their trailing PE ratio over the last 12 months is at 30. A forward PE ratio through 2026, in my analysis, is a 24. So lower than that fair PE ratio that I mentioned earlier. And in my opinion, this makes Meta an absolute buy here at these prices. Now, Meta did soar after these earnings, and they are now well above $700. Although the market did crash at the end of the week, but I still think that they were able to eke out a little bit of gain compared to where they were prior to earnings. But Meta is just amazing. I don't know what else to say. The numbers all look great. The PE analysis here, although very brief, looks great to me as well. I mean, yeah, everything looks good regarding Meta, and it's going to be one that I'm going to keep an eye on here. If it tanks going into next week, potentially through February, it's one that I'm going to have to consider buying again, even though it is already the number one position in my portfolio. And last but not least, the final earnings report that I want to discuss is for Microsoft. Going back to a quarter over quarter, this is based off of their 10Q. Revenue was up 17% compared to this time last year. $81 billion compared to $69 billion during this time last year. Amazing growth on the top line, but even more impressive, operating income grew by 21%. And as I always mention here on my channel, if the top line grew great, but your operating income came in at a higher margin, then you can expect net income to absolutely explode. And that is exactly what happened here with Microsoft, because their net income was up 60% year over year. $38.5 billion almost on the bottom line compared to $24 billion this time last year. Absolutely amazing for this income statement. And you would expect Microsoft to absolutely explode to the upside based on these numbers, right? Well, that's not always what happens with the stock market, because Wall Street absolutely imploded the stock after these earnings. Microsoft was sent tumbling down 9% now year to date. And I want to ask the question, what exactly did Wall Street not like if the income statement looked absolutely amazing? Well, let's get right into that. When I dug a little deeper, it seems to me that Wall Street's number one priority when it came to Microsoft was their Azure or AI cloud computing service, which still did great. Azure and cloud services revenue increased by 39%. I circled that here in red though, because Wall Street did not want to see that level of growth. In the previous quarter, this revenue growth for Azure grew by 40%. The expectation for this quarter that they just reported was 39.4%. So they just barely missed Wall Street's expectations. But probably what was most concerning for Wall Street was that they gave guidance for this upcoming quarter, Q3. They have revenue for Azure and cloud services to grow by 37.5%. That is the midpoint that they are expecting. And as I'm sure you can see by these numbers here, the revenue for AI, cloud, Azure, whatever you want to call it, is deteriorating. And if you want my opinion when it comes to AI, Microsoft's Azure services, while yes, I do agree with Wall Street that Microsoft is spending a ton of money on AI and they should be getting a return, a growing return at that when it comes to these services, I don't think it's the end-all be-all for Microsoft. As we've seen, they still have plenty of other companies that are bringing in massive amounts of revenue and net income for the company. And in my humble opinion, I do think that Microsoft has been oversold and there has been an overreaction to these Azure numbers here. I'm more confident in saying that after I did Microsoft's PE analysis, because I have their fair PE ratio at about a 35, give or take. Trailing PE over the last year, I have them at 27. And their forward PE ratio through 2026, I have at a 25. Much, much lower than their fair PE ratio. And for me, just like Meta, Microsoft is looking like a screaming buy here at these prices, especially after the tumble that they had after their earnings. Now, in my humble opinion, Meta and Microsoft are looking like screaming buys, especially if the stocks continue to tumble here through February. But like I always mention here on my channel, do your own research, come up with your own conclusions, and never make a decision based off of what some guy on the internet thinks. Thank you to everybody who has made it through this analysis portion of the video. But now, for the moment that a lot of you have probably been waiting for, what exactly are the 3 stocks that I bought here in this past week? The first stock that I bought was Microsoft. After seeing that they were down 9% year to date, and after looking at that incredible income statement, I had to build up my Microsoft position. I mean, I don't know. Wall Street is just absolutely insane to me for overreacting the way they are. And if they want to sell Microsoft in the low 400s, give me those shares if y'all don't want them, because I am absolutely going to keep buying. So long as Microsoft stays, I would say anything under 450 to me is an absolute buy. The second stock that I bought here in this past week is more Netflix stock. I did an entire video, a super detailed analysis video on Netflix. So if you want to check that out, I will be sure to leave a tag up here for you. But again, I went into intense detail on why I started to build a position in Netflix late last year. So be sure to check that out. But Netflix to me looks like a screaming buy. It's a stock that's probably going to continue struggling here for at least probably the rest of 2026. But I don't mind that because I want to build up my position, and the cheaper that I can buy the stock, the better. And the final stock that I bought in this past week is one that I really have not talked about a lot here on my channel, but that is Shopify, who is down 17% year to date. And honestly, I really think that I need to do a detailed analysis video on Shopify, especially after seeing how poorly the stock is performing so far this year. If you made it until this point in the video, be sure to give me a like and also be sure to subscribe so that you don't miss out on future videos. I make weekly videos on the stock market, on what I am personally doing with my portfolio, or just giving my opinion on stocks that people comment on. So be sure to subscribe. Thank you again for all the love and support here through 2026. And as always, I'll catch you in the next one. Peace.